What's up, everybody? Welcome back to the Outlier Podcast. I have David Hunter back yet again. We're going to talk about the market, the economy, all things stock market. And as per usual, it feels like there's no shortage of things for us to dive into. So welcome back, David. Great to see you.
Yeah, thanks, Eric. Good to see you.
It's an absolute pleasure. So first things first, what do you make of the market as it sits today? We are hovering near highs. We see slight divergences between some of the different indices, whatnot. Anything catching your eye in particular?
No, I think we're in the melt up. I had somebody ask me today, is the election going to cause us not to have the melt up? I said, we've been melting up. We're up, the S&P is up 68% and the NASDAQ 84%, I think, to the highs from the October 22 lows. So, that's a melt up in my book. We've been melting up. I think the next stage will be a what I call parabolic final stage to this market. So I think we're coming to the end of a 42-year secular bull market thing I've talked about with you many times.
Mm-hmm.
And of course, we're 2 weeks out from an election that, in my opinion, is probably the most important election in this country's history. It's easy to overlook, Civil War, Lincoln, and certainly George Washington. But I think, at least in modern history, the choices here are stark. We either go in a direction where we kind of begin to take back and get back to a capitalistic free market economy and back to, solutions that are not all government solutions, and get away from what I call the New World agenda, New World Order agenda of the left. Or we go in the direction of we could we could see the court packed, and all of a sudden you don't have a constitution anymore because you may not have two-party elections anymore. So I think it's that stark that I know there are people that are say I'll never vote for Trump, but boy, the alternative is basically we won't see America back to the way it ever was before. So I think we're 2 weeks out from that. Um, People keep saying, well, does that mean the melt up's going to end here? And I said, not necessarily. In fact, I don't think so. My convictions are still high that we're going to. I just raised my S&P target to 7,500 from 7,000. I think we could be there this year. So within the next basically 2.5 months, and it doesn't have to. If it rolls over, I mean, if it takes into the first quarter, that's fine. But I think a parabolic means you can cover a lot of ground in a hurry, and we'll see a rally like we've never seen. Don't know whether it'll be completed by the end of the year or not, but it's going to be, I think, a big rally. So that's kind of where I stand. Um, Obviously, there's wild cards that can come in between what's going on in the Middle East. Um, Certainly Ukraine, although there doesn't seem to be likely imminent thing there that's going to change. Um, and what can happen between now and election time, or even at the election. There's, as I said today on Twitter, I think the things we have to worry most about is the left really has made it very clear that it's almost under no circumstance do they want Trump to be president again. So that means they feel they are justified in doing almost anything to stop him. We've seen 2 assassination attempts. We've seen, they've got sitting senators saying on their side saying we're not going to certify his election if he wins. And you've got certainly the cheat that's been going on. So, and they're setting up, when the Justice Department files suit against the state of Virginia for trying to clean their rolls up, their voting rolls up, because there are, an awful lot of illegal immigrants that are not by law supposed to be able to vote, and Justice Department sues to leave those names in there. That tells you exactly what the left is trying to do. I hate to be so blatantly political here, but we're 2 weeks out from something that's, I think, going to be very, very important.
Yeah, well, and I mean, it's in my opinion, I think it's completely reasonable for people to share their thoughts and opinions on this stuff. It's the only way that information moves around. So, yeah, I think you sharing that is kind of part and parcel to the point of doing stuff like this. Now, Obviously, we have to beg the question here, though. The S&P made what a high today of 59.27, 75, long way away from that. What's the catalyst to move from, let's just call it, 59 and a quarter to 7,500 in your eyes?
Yeah, I think I certainly think there's a setup here where I could make the case that we might see a 3% pullback. So, back down to certainly 5,700 wouldn't surprise me. But I don't think we're setting up for a big reversal here. It's a bit of a sell off. And, certainly the NASDAQ could be a little more than that. Russell could be a little more than that. But ultimately, I think it's any pullback here, I think is short lived, might last several days. Um, and then I think the real move here is what has moved this market for a long time here, which is we still have an awful lot of people who have one foot out the door. They see the momentum and they feel like they have to be part of it, but they're nervous as hell and they're saying, this thing could end any time. I think that wall of worry is a source of fuel to keep this thing going. What can move it? Well, I'm seeing clearly the earnings are still in pretty good shape. The economy's uh, defied logic in terms of all the tightening that was done, and yet it's still reasonably strong. You're probably still going to get a 3% GDP number. Um, and the consumer seems to have enough left to keep going through the year. So I think at least for the next quarter, there's, basically all systems go. Interest rates, although they are scaring people because they've backed up, my look at the charts and my look at the overall inflation picture and the economy, et cetera, I think we're bottoming in the bond market and topping in rates here. We had a back up from 360 back to, almost 410, 409, I think. And I think where the next move, I think, is going to take interest rates down to three and a quarter, maybe even 3%. And ultimately, as I've said, before we get through the melt up, we could see 2.5 on the 10-year. So from over 4% down to 2.5 is a hell of a move in rates. It will keep the economy from tanking anytime in the next few months. And I think it'll be wind at the back of the market. At the same time, I think the dollar, as rates start rolling over again, the dollar's poised for a big drop. I think that's bullish. So there's a lot of things there, I think, to complete this. Now, people have to remember the valuations are very high. We're 42 years into a secular bull market, certainly 2 years into a very strong cyclical move. So, I'm not pretending that this is the beginning of, a long run, but I think you're going to cover a lot of ground in a short period of time on the upside.
What do you make of the move in the 10-year yields from 3.595 that was on 17 SEP to where it is today? I think that surprised quite a few people, the strength that it showed from there over the last month.
Yeah, I just say step back, look at the bigger picture. We came down from 475 to 360. It's just, as I use the term, it's just part of the normal stair step. Obviously in the short run, the catalysts were those that wanted to believe that, you buy the rumor, sell the news. So, you had the Fed cut rates, and then all of a sudden you had a strong labor number, strong jobs report last Friday. Um, those kind of things just fed into the idea that, hey, this is the end of the bond move, not the beginning. And so they used it to sell off. Um, I don't, I'm not going for that hook. I really think that's a correction in a bull market in bonds. Um, and as I said, I continue to be, I know there's narrative out there that's opposite to this, but I continue to believe inflation's in very good order right now, moving towards the Fed's target, and that's not going to change. And in fact, I think next year we're going to see deflation ultimately. So I'm not worried about this. The Fed was wrong to go 50 basis points, and it's going to reignite inflation. I think that shows the nervousness that's out there. I think it's wrongheaded, but I think it's that's people are kind of adding two and two and getting six.
Hmm. Yeah, can you talk to me a little bit more about that, specifically the Fed opening with the 50 basis point cut? Because I think that
Yeah.
bounced around a lot for a while, and that I think is a little unnatural for them.
Yeah, well, if you look, the Fed fund rate was close to 5.5. Five
Mhm.
and three. It's 5.5. Um, the the long bond was down at 4% or below, and the 10 year was down at I just said 360. So when they looked at their policy, they said we're clearly too restrictive. No matter what anybody thinks about the strong jobs number or not, the policy was restrictive and the economy is not all that strong. In fact, I'd take apart that labor report. You really have to be a little bit, even if it's not conspiratorial or that they're, playing with the numbers because it's a month out from an election. They have shown over and over that revisions have been revisions downward. You get a number and you think, oh my God, and then the revisions are bigger than the number. So I'm not in the camp that says labor's in great shape or jobs picture is in great shape. The Fed, when they first started talking about a 50 basis point cut, a few weeks ago, they were worried that the previous jobs number had been weak, and in fact, the Fed was getting criticized for not cutting in August or July. So the 50, I don't think they were trying to make up for that, but I do think that really was driven, and I had said this way, well before the meeting, that I felt just based on, I think Austin Goolsbee is probably the guy think has a handle on this better than anybody, and he had made it very clear. He said, a quarter point's not going to get us anywhere near where we should be in line with what the market's telling us we should be or what the numbers are telling. So I don't think the 50 was in any way a panic to a weak economy, nor was it, I think, a mistake in terms of doing too much too soon. I think it was a step in the right direction to saying we got to get policy back in line with certainly what the market is telling us it should be, and also what inflation is telling us it should be.
I see. One of the things that I've been trying to understand myself is when I'm looking at bond pricing, like even a month ago, it was showing a 29% probability of another 50 basis point cut. And that's essentially completely gone now. Now it's looking like an 88% probability of a 25 bips cut. The part that I'm trying to understand with that is that seems like a pretty erratic move, like 29% probability dumping to zero. Kind of what are your thoughts on that kind of behavior in the pricing of the future cut coming up? What is it, 7 Nov?
Yeah, you probably could tell me better than I can because you're in that trading world. It's the erraticness is due to the behavior of the traders. I mean, they're moving. Frankly, they don't have a clue.
Yep.
They're reacting to every data point, and
Mm.
so I think I'm a much more steady as she goes. Typical macro strategist that's looking at a bigger picture, and it's silly to me. You've heard me say
Mhm.
in previous meetings, so it's been a while I've been saying this. I think the Fed's behind the curve. They're not ahead of the curve. They're not printing any money. They're shrinking the balance sheet still, and rates are behind what the yield curve tells them they should be by quite a bit, by over 100 basis points. So, to me, I think you've got a lot of traders who have lots of opinions. I don't think they're necessarily being proven very prescient in their views. So they keep going back and forth based on emotions and based on data points or data releases. And I think it's a silly. It's always been there, but it may be more so lately. And I think that is partly a sign of how nervous people are. But I've been following the Fed for 50 years. I'll put my ability to read the Fed and understand monetary policy against anybody. And I just think a lot of people are amateurs at best in terms of analyzing the Fed.
I think it's fair. I think I also really resonate with your point just on the skittishness, because that's what I've been kind of sensing from things is kind of it feels like everybody's waiting for the shoe to drop. and not really knowing if slash when that's going to happen.
I
When,
I
yeah.
probably I probably underestimate how different my perspective can be because I'm a contrarian. So it's like the nervousness that causes most people to say there's something out there, it doesn't feel good, is the same thing that causes me to have conviction and say, as long as everybody's nervous, I'm fine. So I think part of it is just the natural contrarian in me. I don't get shook up by the street going, completely in that direction.
Yeah. So leading into the 7 November meeting, what's your general thought there? Obviously, right now it's looking like a 25 bips cut, but I'm also just curious in terms of what you think the Fed might address during that meeting, not to preempt the move and not that the Fed drives the market. I'm just kind of curious your thoughts on like what the focus is here.
Yeah, I think it's going to be pretty much there. And I think Paul's been saying this for a while. They're trying to be steady as she goes, not jump around with the markets and not jump around with the data and say, when we look at the trends and when we look at overall picture, we think the move is in the direction of ease or less restrictive. But it doesn't mean that it has to be big steps. We're still going to be kind of diligent in how we approach this. And I don't know whether it's going to be 25 or 50. I don't think it's going to be anything outside those two. I think people who are worried that there's going to be no cut are wrong. I think people who think there's going to be something bigger are wrong. But I think it could be 25 or 50. And frankly, I don't think it matters which it is in terms of my market outlook. I'm bullish either way.
Leads me to a follow-on question though. Your perception, if it is 25 versus 50, just for like a learning case study, how would you differentiate perceiving those two different outcomes if they do 25 or if they did 50? Like, what would you take away from that?
And you've heard this from me before, I think. I really pay much more attention to the bond market
Yeah.
than what the Fed does in any given meeting because the Fed follows the bond market. Not precisely, and they're not, sometimes they'll go in opposite direction of the bond market, but I mean the general move in rates is first dictated by the bond market, and the Fed being kind of looking at backward looking data and driven by they just tend to be later or slower. So I'm getting my lead. I'm taking my lead from the bond market, and as I said, I think you bottomed in the bond market, whenever it was a few days ago, and then you kind of had a gap up one or two of those days, and today you're filling back into towards that bottom. So I think you're getting kind of a very short retest. And so I think you're basically at the lows, at the highs in rates and the lows in the bond market here. And as I said, I expect to go from, 409, 410 down to towards 3%. And if you're getting that, I'm not too worried about whether you get it before November 7th or after. Whether they do a quarter now and a half in December or do two halves or 2 quarters, the bond market's going to be there. The Fed doesn't drive the bond market. The bond market drives the Fed, or sort of drives the Fed. So I have more faith in the collective wisdom of the bond market, not any individual bond investor, but the collective wisdom of all those entries into bonds. I have more faith in that as a dictator of where rates are going, and I think I can consistently or see more consistency in the fact that rates are, headed lower. I have more faith, I guess, in being able to read the bond market than read members of the FOMC.
It makes sense. Now, that's always been a phrasing that I'm really interested by, the idea of dictated by the bond market versus predictive. Do you think the bond market actually dictates, meaning forces the hand of the Fed? Or do you think that the bond market is really good at preempting what the Fed is most likely to do, just from a causal relationship analysis?
Yeah, because the bond market is not rates. This is a misnomer out there. Rates are not driven only by what the Fed's going to do, up or
Right.
down. There's the economy, there's inflation, there's obviously the jobs picture that the Fed's looking at, but there's a lot of things out there. There's supply of bonds coming from the Treasury. If we're just speaking of the Treasury market, so it's supply demand driven, it's data driven, but it's bigger picture driven. It's the overall sense that a bond crowd, meaning all bond investors all together as one market, put inputting all of the factors and variables that are there that you'd have to have some supercomputer to do. But in the aggregate law of large numbers, the bond market is pretty efficient at capturing all of that and determining what I think the future direction of rates is. So it's not just the Fed. It's really just like when we're making calls on the stock market. It's the stock market is pretty good at when you look back, you go, who would have thought the market would have gone up from 3,500 to 5,900 in 2 years based on what everybody thought in the last 2 years. But the market in its aggregate predicted correctly that we didn't have a recession. The economy held together better than people expected. Earnings turned around and have been better. And so, again, not really efficient market, but law of large numbers, it tends to get things over time pretty right. Now, that's not to say it doesn't have cycles and it goes one direction and it corrects back the other. But I'm not Fed driven in terms of looking at rates. I'm really more, market's telling me, and I look at it both fundamentally and technically. Technically, I think the bond market looks like it had a pretty normal correction given how far it had come, and is now poised for another leg up.
Got it. Do you think that there's any impact or relationship with the Chinese market as it sits now? Obviously, the last couple of weeks, they started talking about different stimulus, huge run in all sorts of Chinese-based ADRs. Does that fit into your broader thesis at all?
I think what we saw in China was a big part of it was short covering. I
Mm,
mean, people were so it was in a bigger way akin to the Japanese carry trade, and that everybody was betting on, the yen had been falling for years, and so even though people knew at some point it reversed, nobody was expecting it when it happened, and when it happened in a vacuum and went up fast, and it forced the carry trade reversal. Um, so this one wasn't carry trade, but it was again people had pretty much written off China, saying, they just got too many problems. We're looking elsewhere. Our focus is not China. And, even if the valuations there are looking cheap, we don't care because China's got a problem, huge problem on their hands. And then all of a sudden, China surprises and nobody anticipated. They all knew, kind of like Japan. You all knew at some point it would happen. The investor didn't anticipate it would be immediate, that China would all of a sudden come up with a big policy reversal. And they did. And because that vacuum was there and a lot of shorts, you had this big rally. A big part of it, I think, was short covering, and just people, the David Teppers of the world looking and saying, "Wow, look at the kind of reversal in liquidity we're going to see there. That's bullish for not just the next 2 weeks." So you had, and people followed him in. So you had that. My guess is it obviously has corrected pretty sharply from that initial run, and then you'll have another run. I think a more orderly run. So China in its own, kind of its own picture. I don't see it as a long bull market, but I do see it as probably rallying along with the rest of the world as we finish out this cycle. Um, and I don't, their liquidity obviously helps global liquidity. The fact that they've turned on the taps a bit now helps global liquidity. But I think this thing, basically, the seeds were sown for this melt up and China's, a minor help to that.
Got it. And out of a general personal curiosity perspective, do you have any thoughts on the real estate market there and any potential impacts to the melt up if there is some sort of big issue with the Chinese real estate market? Because that's always in conversation to a degree, but I don't know exactly how important that is. It sounds like the market less so. Anything from the real estate side?
I will say, because I am looking for a global bust next year. There's no doubt in my mind China's going to play a role in that. There's no doubt in my mind that China real estate's going to play a role in that. So I don't think it's over. I don't think they're out of the woods. I don't think it's marked a major bottom. I think this was a bottom on the way to a much deeper bottom in the bust. So, and I'm talking the markets, but also the real estate, same thing. You might get a little relief there as they provide liquidity and they do some of the things they're going to try to do to stop the meltdown. But ultimately, I think there's a much deeper bottom coming for the whole world, but certainly for China and China real estate next year.
Got it. And for the yen carry trade specifically, that's been prolific almost at this point. It's been ongoing for so long, so much conversation around it. Why do you think that it went down the way it did, specifically in terms of at least your perception of the unwind and people being caught off guard? Because to me, it seems like there's so many eyes on it. How do you miss it?
You miss it because you didn't anticipate it. When it actually happened, when the yen reversed, it reversed in such a violent way because it was in a vacuum. That immediately made those carry trades very expensive. I mean, people were. It's not just interest rate; it's the foreign currency on that rate and so all of a sudden it drove your cost of carry up so fast, overnight, that and people were leveraged with that people had no choice but to say, I got to liquidate. I can't carry this. So you had the whatever percentage of those that were using the yen for their and borrowing in Japan, whatever percentage were in a very tight spot and very leveraged, that had to happen almost immediately. Then the balance of people who had less leverage and had more ability to kind of work out of the situation were given plenty of time in the following weeks because the yen backed off. We've had the yen back off for the last basically 2 months. So those that had the luxury of time have been able to work out of the trade. And so you had the immediate, what you always do, the kind of the immediate margin call, and then others who said, yeah, I don't want to be there long term, but I don't have to liquidate right now. And I think the odds are that if you didn't do it in the last 2 months when you've been given a second chance, I don't know what you were waiting for. So the odds are that the majority of that carry trade's been reversed.
Got it. Switching gears a little bit over to commodities, crude oil had a pretty wild move, relatively not crazy, but it hit a low of 65 in September. And then it hit a high of, what was the high here? 78.48 on the 8th of October. And now it's been trailing down. Thoughts on the move there?
Yeah, I mean, as you know, I've been the bear on the street for oil, and I'm still looking for 60, and I actually think there's a decent chance we see something in the 50s before the end of this year. So obviously, the wild card is the Middle East, and if Iran hit the oil fields or Israel hit their oil fields, we could have some disruption there. But my sense is the higher probability is that oil is going to continue to trend down, that we had that scare, that move from 65 to 78 was entirely based on the Middle East and entirely a scare. It wasn't based on supply and demand. And now we've rolled over, and it looks to me like you probably headed for 60, barring something, happening immediately here. And I would say it can get into the 50s. then bounce. Maybe it bounces back to the high 60s or to 70. And then ultimately in the bust next year, I think we'll see $30. And that will be, I mean, I don't even know whether 30 is the bottom, but somewhere down there. And then that will be the lows in oil. And coming out the other side of the bust, when there's so much money printed to deal with the bust, you'll begin a long bull market in oil. So if you get, let's say 30 is the bottom, I think you'll see 500 by early in the next decade. So 30, 2030, 2031, somewhere in there. $500 from 30 on oil. And then you can imagine what that does for any oil equities. So I think you just got, we're in a bear market in oil. It's been down since 130, and in the spring of 2022 when Russia went into Ukraine, it spiked to 130 from 85, and it's been working its way down ever since. So, and people don't seem to understand these things all move in a jagged form. It's a stair step process. You're going to have moves down, and then you're going to move back up. And people always are always asking me, "Are you done with your bear call? Do you think now you got this wrong?" And I said, "I didn't get this wrong. It's what's expected. You're going to go. You had a big sell off. You're going to have another bounce. Did it go farther? Sure, because of what's going on in the Middle East." I would have not been surprised by 75. 78 is a little higher than I would have expected, but I'm not surprised by it at all because of the big things going on in the Middle East. But I think barring a big event over there, I think you're on your way back down.
What do you think the thought process is between OPEC production right now? Why are they maintaining the current path that they are?
Yeah, I mean they can't keep cutting because they need revenue. They've cut a lot,
Yeah.
and they certainly don't want to increase at this point. So I think it's kind of they'll do little cuts at the margin maybe, or at least talk cuts. Give some rhetoric and things like that. But basically, and this is a surprise, but we're producing a lot of oil in this country, in spite of it being in the Biden administration. Yes, Trump would be producing more, but we're producing quite a bit. The oil companies have really been doing a lot, and of course China was down and wasn't demanding oil. And I had a conversation this week, or there was a stream of conversation on my feed about the EVs in China. I focus U.S., so I don't pay much attention, but I guess they've made huge inroads over there in terms of switching over to EV. And so, their demand for oil has been going down for that reason, but it's also going down because their economy has been tanking. So, they're doing far less in heavy industry, et cetera. They've been kind of pulling back from all that stuff, trying to wind inflation out and all that. And now they've started going the other way because it was hitting their real estate so hard. So, but all of that, I think, is, China is a dominant player in the oil markets and just didn't have the demand. And that's, to my credit, I wasn't focused on China so much, but globally, I said there's a lot more oil in the world versus supply than people are versus demand than people are giving accountants to. So, I think we are seeing that's going to continue right into the global bust. That ultimately we have excess supply over demand, and that's not going to change in the next year.
Got it. Another thing that's been really interesting is even the latest news with Google talking about their entrance into nuclear power to help essentially power, their AI and GPUs required to run the AI. What are your thoughts on nuclear power?
Yeah, I think nuclear has to be part of the answer. It's I've been pretty vocal in saying, which is part of my $500 oil call, is it's nice to talk about alternative energy, but we're nowhere near being able to replace fossil fuels in terms of what we're going to need. And if you have what I fully expect, which is a goosing up of the next cycle as we print money like we've never printed before because of a free falling financial system next year, global bust. If we see 20 trillion in new money in this country and proportionally around the world, you're going to goose demand like you've never seen because it's also coinciding with us reshoring and starting to go more industrial again, et cetera. The demand for oil is going to go through the roof. The demand for energy is going to go through the roof, and there's nothing that can you're not going to be able to produce enough wind power or solar power to offset the need for energy. So it goes right back to oil, and of course, oil. It takes many years to develop a new oil field, and we've spent all this time forcing our oil companies to do less drilling and less searching, and we're trying to move them away from it. Uh, you're going to have a goosing of demand in a very short 5-year time span, and not the ability to produce supply to meet it. And what gives is price. So so that's a long way of saying we're going to have other alternatives, and nuclear is one of them. And the fortunate thing is the technology has progressed to the point where it'll be not the big 20-year projects, but rather the smaller nuclear plants that they can, they've got the technology, they've got, I think the regulation's going to, particularly under Trump, is going to improve time wise so that you can actually put those things in on a timely basis. So there's no question we're going to see more nuke.
What are your thoughts on gold? Gold's been hovering near highs essentially from the 26th of November, trended sideways for a little bit, dipped down into like the 26, 27 handle, and now it's hitting highs.
Yeah, back, I guess it's probably several weeks now. I don't know whether it's a month, but certainly in the last month, several weeks. Um, I raised my target on gold. I had a $3,000 target, what I call pre-bust target, meaning before next year's global bust, um, and probably a first quarter. Probably happened in the first quarter. I had a 3,000 target, and when gold was starting to push up against that, it had been kind of consolidating in 24,500 area. Around there, I said I'm raising my target. So my new target is 3,400. I think we could be there in the first quarter. Very, very much think that's likely. Um, so I'm very bullish gold here. You'll have pullbacks along the way, as with every market. So, maybe it goes 2,900 and pulls back 100 points or something. But I think we're on our way to 3,400. And then in the bust, as with most assets, it's going to go down. So you might go 3,400 back to the mid 20s, 2,500, 2,400. You might even go all the way back to 2,100 where it broke out from, last year. And that would be, more than a 30, probably a 35% pullback, I would guess. So 35 to 40% pullback. I think that's possible in the bust. But, big run up here, correct. And then, my target for end of this decade, early next is 20,000. So there's a lot of upside in gold still to come.
And got to talk about the catalyst there. It's hovering around 2712. So I assume it has everything to do with your broader thesis. So, but what's the order of operations here? We have market melt up, then we're talking about gold starting to run. How does the relationship between these different things work in terms of specifically the gold estimate?
Yeah, I've been pretty consistently saying for the last year or two that I felt the metals and the equity market would move up together. And people would take me to task on my bearish oil call because they go, oil and gold always go up together. I go, no, they don't always go up together, and they're not going to go up together, and they obviously haven't. So I think, I think they're coincidental. I think you will see the equity market melt up to 7,500. I think the S&P, and I think gold. You'll see, it's not a melt up, but it'll run to 3,400. And I have 75 on silver. So there's big runs, I think, in metals and in the equity markets and in bonds. And what drives the gold market? I think it's a weak dollar. The dollar's been counter trend rally here for a while. I think that's pretty much run its course. I would expect from this 103 and change to see the dollar certainly down to the mid 90s and maybe 90 within the next 3, 4 months, 5 months, and ultimately down to I had been saying 80. I've raised a little bit to 82 is my ultimate dollar target. And that could happen early in the bust or before the bust, but given how far it has to come, I wouldn't be surprised if the early part of the bust you're still going down in the dollar. In the bust, in the guts of the bust, the dollar can rally back to 120. People are going to flee to safety. Around the world, the dollar will still get that flight to safety trade. But for the next 6 to 9 months, I see the dollar heading straight down. That's probably the biggest driver of gold is that weak dollar. And then, lower interest rates certainly helps gold. And fears of Fed easing leading to inflation could be a part of the narrative. Like I said, I'm worried about deflation, not inflation, but that doesn't mean the market won't worry about inflation.
And how does silver play along here? Because silver was interesting. It hit a high of 33 in about a quarter, like the beginning of this month, end of last, I think. And it's been kind of running a bit sideways here. It had a little bit of a pullback and then has been running sideways. So, yeah, curious how silver fits in.
I expect, and it could be momentarily, tomorrow, the next week. I expect silver to outpace gold. I think it's starting up here. It kind of had to pull back. I think it got ahead of itself a little bit this week. But ultimately, it looks, I said yesterday, I think on Twitter, we're there. Basically, we're at that point where it's about to break above that 33 level that it had gotten to. And I think you can probably see it up to mid 40s in the next, certainly this year, maybe in the next couple months. And then from there, may keep going or may pull back for a little while but ultimately 75. And I think so. Gold and silver, I think, trade together with, as is normal in bull markets, silver outpaces gold in bull markets. And I think that's going to be the case. The miners, I think, will finally reward investors who have been very frustrated by the fact that certainly gold's done very well, and silver's up 90% from its lows of a couple of years ago. And yet, the miners have been languishing. So they're starting to get a little more bid. And I think that's just going to accelerate from here.
What's the thought process in your perspective of people to choose silver over gold or gold over silver? Do you think most people that are moving into the metals like this are splitting between the metals? I want to understand from a broader perspective how you break those down and the perceptions of people and how they use both of them.
Yeah, simply put, well, certainly, first of all, gold is obviously more of a monetary metal. It certainly is. A lot of it is, world events. A lot of it is the dollar. A lot of it is, some place where you can get away from concerns about inflation, et cetera. Silver, on the other hand, has much more real cyclical exposure to, solar panel markets and EV and lots of other things. So there's more of a cyclical component to silver. But right now, I think there's plenty of demand for silver cyclically, and silver has that other component, which is it is poor man's gold. So it's not a pure monetary metal, but there are a lot of people that will run to silver when gold's getting a little bit expensive, and you get more bang for your buck, it seems, or it's like stock splits. You're able to buy more of it if you can buy it at 30 something, and gold's at 2,700. But the simplest way to put it in terms of, as I see it anyway, in terms of gold versus silver, is that in bull markets, silver will outpace gold typically. So that gold silver ratio, which was up around 90, a year ago or whenever, should get down towards 40. If gold divided by silver gets down from 90 to 40, that tells you silver's way outpacing gold, right? So in a bull market, you want to be probably more heavily weighted in silver. And then in corrections, or when we go through the pullbacks in these metals, particularly during the bust, if you're going to own either one, I'd probably own gold, you know. And then on the other side of the bust, they're both going to be skyrockets, and it's personal preference as to where you want to be there, but silver will probably outpace.
Now, when we're thinking about the broader bust here, though, do you where do you think the transfer, or I'm maybe projecting here, maybe there isn't, but do you think, maybe is the best way to phrase it, do you think that there's a transfer of capital from equities into metals? And if so, where's that relationship? When does that start to happen in droves?
Yeah, the biggest time, I mean, silver will probably get hit much harder than gold in the bust. So gold will outpace equities during the bust. If I'm calling for an 80% bear market in the stock market, in the U.S. stock market, and I say gold could drop back 35 to 40%, obviously that's a much better place to be than equities if you had to be somewhere. Silver, on the other hand, if it goes to 75, it could easily come back to 30, or maybe even back into the low to mid 20s, because it is so cyclical. And if we go through a worst economy, worst financial situation we've had in post World War II era, you're going to see big hits to things like silver. So silver is not something that's going to protect you on the downside in a bust. The bigger story, which is I think what you really want to know, is the post bust era, when we're coming out of that bottom and the Fed's printed so much money. It is going to be a cycle where commodities of all kinds will far outpace the equity markets. And it'll be a high inflation environment. Ultimately, it'll start out slow, but in the decade, we could see 25% inflation. I expect gold and silver to be leaders of the pack in terms of performance leaders, outpacing almost everything else at the end. But during that commodity cycle, you can have, as I say, if the stock market drops 80%. So let's say, it was easier math when the S&P, my target was 7,000. And I'd say you can go down 80%, that's 1,400. But from 7,500, let's say it's 1,500. I don't know what it is. You can triple that number and be at 4,500 or 5,000, and still be way short of that 7,500 cycle peak this year. Obviously, my numbers are just my guesses, but so you can have a cyclical bull market that will never come close to the peaks of this cycle. On the other hand, gold and silver and copper and oil and ag commodities are going to see highs many-fold beyond anything they've ever seen before, because it's going to be driven by all that money. It's going to be an inflation cycle. And so natural gas might get down to $1 in the bust. Who knows where gas goes next cycle? Natural gas might be $40 or $50 next cycle. Go from $1 to 40 or 50, that's 40, 50 times. Gold going from, let's say, 2,500 to 20,000, that's a huge run. Silver going from, let's say, 20 to 500 is my target in the next cycle. So those things will outpace. Oil will go from, let's say, 30 to 500. Meanwhile, you've got you can have a couple of years where the equity market is still, it's not keeping pace with other things, but I mean, it's not going to be what the commodities are through that whole cycle. But for a couple of years, it might be a pretty good place to be. But then what you're going to run into is the headwinds of higher rates. If interest rates can Um, Interest rates will track inflation. If inflation can go from deflation next year to 25% inflation by, let's say, 2030 or 31, um, then interest rates are going to go from, I have said, I expect the 10-year to be down to zero next year in the depths of the bust. You could go from a 0 10 year to 15 or 20% 10-year by the early next decade. Um, so so if you have interest rates doing that, that's a huge headwind for the stock market because PE multiples are the inverse of rates. They move inversely to interest rates. So that's really what drove the last 40 years is we had interest rates go from high double digit in the early 80s down to almost below 1% in 2020. So you had PE multiples go from single digits to 25 or 30. Um, and that's, we're going to have the reverse of that post bust because it's going to be a huge inflation cycle.
A curiosity I have with respect to the bust is normally when we see markets go through these larger corrections, even to bear markets, extended bear markets, normally there are still elements of strength, either in markets, commodities, somewhere. Do you see anything showing strength at all during the bust, or is this literally everything is coming down together just in different degrees?
Two things. One, treasuries. If I'm looking for a 0 10% in the bust, and let's say it gets to 250 before the bust, there's still a big run up in the treasuries between 250 to zero. And short rates will go below zero probably. The long bond will probably get down to a quarter or a half. So that will be one asset that will not only not be going down, but will be going up while everything's falling apart. So that's the number one asset in the bust, in my opinion. And why? Because of the government guarantee, because of the printing press. As I say, in the 2030s, when all collapses, it won't be the same story because you won't have the government guarantee won't mean much because the government will be bankrupt. But in this, because of the printing press, um, I think you can pretty much be assured that they'll honor all those treasuries. Um, so the treasury is first and foremost, and the only other asset I come up with is the dollar, because, and not from here, but from that 82 at the lows or wherever it goes to. If it can go back up towards 120, you got two appreciating assets, and the rest of the asset structure, whether it be private equity, whether it be leveraged loans, whether it be corporate bonds and particularly junk bonds, whether it be the stock market, whether it be commodities, they're all going straight down. So having your money in either an FDIC insured savings account or a treasury bond or any treasury security, any maturity, or the dollar, those are about the only things that will, I think, protect you.
I see. Last question before we wrap up is, obviously your thoughts are that we're in the melt up now. It's likely to hit a crescendo, either towards the end of this year or Q1 next. What are some of the warning signs as far as you can see now of when we're in the melt up? What does it look like when the melt up is slowing and starting to show cracks?
Yeah, I think what you're going to have is an all-in market. So right now, as I say, people are starting to raise. Just looking at Wall Street strategists, for example, they're starting to raise targets. You've seen a couple 6,000 numbers out there lately. I was the only one for 2 years. I mean, people thought I was crazy, but now you're starting, as you're getting closer to it, you're starting to see the numbers raise, and so people who had targets of 51 or 5,200 6 months ago now are talking about 57 or 800 or maybe 6,000 for a couple. As we move along here, you can see those targets raised. You're going to start hearing more talk about this has legs, that it's not just into the end of the year, that because we're starting a new easing cycle, that this might run for a couple of years or longer. That's what will capture the institutional investors' attention, is if they think this isn't the end of something, it's the beginning of something where they can they can discount the earnings out a couple of years that are high earnings out a couple of years, and maybe even longer. Their models will now be able to make sense of this where we are, because they've been struggling with the valuation and saying, there's not much room left. This thing is going to come to an end here shortly, and we don't want to be buying the top. If they really believe this is the start of something, you'll see them ramp up. And that's why I think you're going to see the whole final move happen in 2 or 3 months or less. Yeah, it sounds crazy to say you can go from 5,900, 58, 5,900 to 7,500 in between now and the end of the year. Except if everybody comes to the same conclusion that, oh, the Fed is actually really easing, that the economy isn't strong, that there's a cycle ahead, they'll act on that in a short period. They're not going to wait months to act on that. So you can get that parabolic final run. That now, of course, they're not going to be looking for a bust. I'm looking for a bust. They're going to be thinking the cycle's just getting going. Um, what what you'll be looking for from a stock market standpoint is everybody being bullish, everybody being all in, everybody having that bullish narrative that says this has legs and it can go for 2 years or 3 years. Um, when you hear people saying it's Goldilocks and you've got, earnings are moving up, interest rates are moving down, inflation's under control, the Fed did the Fed managed this perfectly. Those are the pieces of the narrative that I think will tell you you're getting close to the end, from a stock market standpoint. From a looking for signals of the other side, um, it's going to be tricky because if we're up on stilts, it's people aren't stupid out there. If they see the signs that things are getting bad, it won't be up on stilts. But I think initially weaker economy slowing, because I'm still in the camp that says the recent strength is kind of a facade that basically, yes, we're getting a last hurrah in consumer and things, but there are cracks showing underneath, and the labor isn't as strong as those numbers indicate, et cetera. So I wouldn't be surprised in the next, between now and the end of the year, if we start getting some signs that things are moving closer to recession, or aren't as strong as we thought, and recession's looking more likely. But that's not necessarily going to be received bearishly, because it means the Fed's going to have to get more aggressive. So when it turns into more bearish is when it turns out it's not a soft landing, it's not a mild recession. It's, oh wow, things are really deteriorating fast. We almost had that in July, right? We had some numbers there that surprised us to the downside, and it looked like it was speeding up, and then we got caught our breath again, and we got a little more strength. I suspect before the end of the year, it's going to go back the other way. It'll be received initially bullishly, and it's only, I think, as we get into early next year where what you'll be looking for is the numbers to start really accelerating to the downside, whether it be, ISM numbers, retail sales, housing, because I think homes are kind of getting a last hurrah, because those that felt they missed it are getting a reprieve because rates are coming down, mortgage rates are coming down. But they're buying almost too quickly because rates are going to come further down, but there won't be more buying power behind that, because those that wanted to buy now are kind of jumping the gun now. And soon after this, it's going to be, there's more inventory, there's not another wave of buyers, and all of a sudden the house prices start slipping. I think that will be one of the early signs that, next year is not going to be what this year was.
I see. Fascinating. Yeah, it's really interesting to see the melt up thesis and seeing how it unfolds. So as always, thank you for kind of sharing and walking through that with us. Before we wrap, is there anything else though that we didn't talk about that you want to hit on?
Yeah, the only thing I would say, just kind of furthering out the talk about the bust, is people just have to remember the melt up seemed crazy at the time too, and people fought it and fought it and fought it until now. Now people were throwing around the term melt up, but for 2 years they really thought I was crazy for thinking the market could do anything like it's done. The bust, people want to be able to see it. They think now they're starting to question, isn't it possible you're dead wrong on the bus? I say, yeah, it's certainly possible, but
Sure.
my convictions are still high that that's where we're headed. But don't expect that it's going to be obvious that you as a retail investor or even you as an institutional investor, um, not you but anybody,
Sure.
um, that it's if it were obvious we'd be acting on that now. So it's not going to be obvious for a while yet. Don't use that as the sign that it's we're not going to have one, because it'll all of a sudden show up. But I think we've still got, between now and the balance of this year for sure, plenty of room for this thing to run, and bust type signals are just not going to be there.
Fascinating. David, always absolute pleasure chatting. Thank you so much for taking the time, sharing a little bit about, I don't know, your thoughts, your experience. I always appreciate that you're willing to go through the different questions that I have, because it helps, I think, a lot of people piece together this broader picture, because it's fascinating. So obviously, people can get a hold of you on X. I will throw a link to your profile just to make sure that they're going to the right spot if they're interested. And then you also have your newsletter, I presume. And if they're interested in that, they can DM you.
Yeah, I just put out my fourth quarter letter last week.
Perfect.
And as I said, I raised my targets on S&P to 7,500 and NASDAQ to 25,000 from 24, and then raised my gold target to 3,400. So that is a letter that I send out to subscribers. So it's by subscription. There's a cost to it. If people have interest, yeah, they can just direct message me on X or Twitter, whatever you want to call it, and I'll be glad to give details, and they can decide whether it's something they want to subscribe to.
Yeah, perfect. So then I'll have that in there. As always, David, great hanging out. Thanks for sharing, and we will see you next time.
Yeah, great to see you, Eric. And I think 2 weeks from now we're gonna see some history made,
Looking forward to it.
one way or the other.